One of the first lessons most investors learn is that valuation matters. We are taught to look at price-to-earnings ratios, price-to-sales multiples, and discounted cash flows to determine whether a stock is cheap or expensive. And for long stretches of time, valuation does matter. Stocks that are overpriced tend to underperform, while reasonably valued companies tend to deliver better long-term returns. But then something strange happens. Markets enter phases where valuation seems to stop matching entirely. Stocks trade at extreme multiples, prices rise far beyond historical norms, and investors who rely strictly on valuation are left confused or left behind. To understand why this happens, we need to understand when valuation matters and why it sometimes doesn't. Valuation is ultimately a tool for estimating long-term returns. When you buy a stock, valuation helps determine how much future growth is already priced in. The higher the valuation, the more optimistic the assumptions embedded in the price. Over long periods, these assumptions tend to mean revert. This is why valuation works best over years, not months. But markets don't move only on long-term logic. They move on flows, expectations, and changing conditions. In normal market environments, valuation acts like gravity. Companies with solid earnings and reasonable valuations tend to attract capital. Extremely expensive stocks struggle to keep rising unless earnings grow fast enough to justify the price. In these conditions, valuation is a useful anchor. However, this balance depends on one critical factor: the cost of money. Interest rates and liquidity dramatically change how valuation is perceived. When interest rates are high and liquidity is tight, future earnings are discounted more heavily. Investors become less willing to pay high prices for growth that may not arrive for years. Valuation discipline returns, and expensive stocks are punished. But when interest rates are low and liquidity is abundant, the math changes. Lower discount rates increase the present value of future cash flows, making high valuations easier to justify, at least on paper. This is when valuation starts to feel irrelevant. Liquidity doesn't just change valuation math, it changes behavior. When money is plentiful, investors are pushed out along the risk curve. Cash earns little, bonds offer limited returns, and capital flows toward equities and growth stories. As more money chases a limited number of assets, prices rise regardless of traditional valuation metrics. This creates feedback loops. Rising prices attract more buyers, reinforcing the trend. Narratives become powerful during these periods. When valuation stretches, investors often justify prices with stories about disruption, transformation, or paradigm shifts. Sometimes these stories turn out to be correct. Other times, they are simply convenient explanations for excess. As long as liquidity remains supportive and sentiment remains positive, valuation warnings are ignored. This is why valuation can seem broken during certain market phases. But valuation never truly disappears. It only becomes dormant. Eventually, conditions change. Liquidity tightens, interest rates rise, or growth expectations falter. When that happens, the assumptions embedded in high valuations are re-examined. Stocks that relied heavily on optimistic futures are repriced aggressively. This is when valuation suddenly matters again, often violently. This shift can feel abrupt. Stocks that were celebrated for years can fall sharply, not because the business suddenly collapsed, but because the price no longer aligns with realistic expectations. Valuation acts like a delayed reckoning rather than a constant constraint. This is why market downturns often feel unforgiving. Another reason valuation seems irrelevant at times is time horizon mismatch. Long-term investors care deeply about valuation. Short-term traders care about momentum, sentiment, and flows. When short-term forces dominate, valuation signals are overwhelmed. Markets can stay disconnected from fundamentals far longer than most people expect, but not forever. Understanding this dynamic is crucial for investors. Valuation is not a timing tool. It does not tell you when prices will stop rising. It tells you what returns are likely once the cycle turns. Ignoring valuation entirely is dangerous. Relying on it too rigidly can also be costly. The key is knowing which phase the market is in. In summary, valuation matters because it anchors long-term returns, but it temporarily stops matching when liquidity is abundant, rates are low, and optimism dominates. When conditions change, valuation reasserts itself, often suddenly and painfully. Markets don't abandon valuation, they postpone it. Once you understand this, valuation stops being confusing and starts becoming contextual.